Our 2015 forecast. Now this is thoughtful. Hello, I'm Trevor Lai in Shanghai. To start out 2015, we're bringing you our 4th annual forecast episode this week on Thoughtful China. Late last year, President Xi Jinping told a gathering of Asia-Pacific business executives not to worry about the Chinese economy, but there are plenty of reasons to lose sleep. China's economy is forecast to grow at a rate of 7.5% this year, the weakest pace since 1990, and the direction appears downward for the foreseeable future. So is China heading for a hard landing? Are multinationals concerned about consumer spending next year? We'll find out this week on Thoughtful China. And JWT's Tom Doctoroff will have a thought or two about what a declining economy in China means for marketers and agencies overseas. But first, with us are the China CEOs for 3 of the top media agencies in China. ZenithOptimedia's Mikim Shikli, Omnicom Media Group's Doug Pierce, and Carat's Adil Zain. Mikim, Doug, thanks for being back on Thoughtful China. Adil, welcome to the studio. It's great to meet you.
Thank you.
So, Mikim, let's start with you. You've just finished a series of big budget meetings for the coming year. What are you hearing from clients about spending in 2015?
Well, that's a tricky question. Let's be positive a little bit. I think our clients still believe that there is a huge opportunity in terms of growth in China. So I think that's a good news. Though they're a bit cautious because they definitely want to see an ROI comparing to
previous years.
Yes, the previous years. So here comes the tricky part where we need to advise them in terms of, budget split and where they should invest the money at the first place. So I'm seeing still a growth, though it's a slower growth than the previous year. But I'm seeing something new is what they call freeze budget or freeze envelope or security envelope, which in the previous year, usually they don't even talk about it.
What does that mean?
It means that they have some reserve budget. If things are going well, we're going to spend this budget, we're going to invest this money. If sales are actually not going the right way, I think we're going to freeze the budget. One thing is important, and I think that our clients start to get used to a slower growth. So they are more cautious in terms of setting up targets. And they use us, I think, a lot to go back to HQ when they have HQ, or go back to the boss saying, well, you have to tell them that it's not reasonable. We cannot have these sales targets. We need to achieve our target, so we need to have a target that is achievable.
That's interesting. So, Doug, are you finding this as well as media partners, that you are actually helping perhaps the China operations lobby HQ to lower their expectations?
To a certain degree, we're finding that. At the same time, most of our clients have tempered back their growth expectations, and figures of increases in the 15–20% really have gone for many of our clients, and they're now more in the 8 to 10, maybe 12% growth, which we obviously support. Advertising agencies are traditionally good at encouraging clients to spend, so this year is no different from many others, but there's a big watch out on inflation. I think that's the key that clients are saying, what is the media inflation going to be, particularly more this year than perhaps other years.
And Adil, are you also finding that clients are presenting you with this freeze scenario that Mikim mentioned, where they're, setting a bar, and if their sales don't, achieve that threshold, that they're actually going to have measures that impact you?
Yeah, in some instances, I think they're just generally being a bit more cautious, and I think we've seen this trend last year as well, that they tend to save up a little bit of the spend and release it towards the end, depending on the sales performances. So yes, I would use the word cautious for most clients, but also optimistic with regards to a more stable and sustainable growth in spending as well.
Well, were there any surprises, though, in your meetings when you were talking to clients? For example, did you have any that were surprisingly optimistic and surprisingly liberal in their spending, or were they all across the board, tightening their belts?
It depends on the kind of clients. If you're looking at some relatively new entries in the market, obviously they're very robust in terms of their spend plans, etc. But generally, pretty similar with regards to established advertisers in this market.
And obviously, it would vary by industry. And were there specific industries that you found were a little bit more optimistic than others?
Well, I think FMCG business is doing quite well. Again, the growth is slower, but they're doing quite well, so they need to sustain that. I definitely agree with this. And then some of the brands that are taking some market share, they know that they have to invest more than the competitors, so they definitely see an opportunity where somebody is slowing down. You'd still have someone who will see, oh, they're slowing down here, so I need to take the leadership and take this opportunity. So obviously we're helping them in that area. I think the cake is becoming bigger in terms of consumer, but actually the share within the cake is becoming smaller
becoming
because
more fragmented.
You have more brand.
Right.
And it's very difficult on a retail standpoint, for example. That's very difficult. But it's also true for the media industry, and in particular in digital area, and in particular where the government is actually restraining the cake, talking about online TV specifically.
Sure. Let's take a break to hear from Tom Doctoroff, who will share a thought or two about what to expect in 2015.
I love the fact that Thoughtful China hits issues that are relevant and current. Gives us a platform to discuss the issues that are relevant to brands, marketers, as well as the agencies that are supporting them.
It's time once again to gaze into the crystal ball. Across the region, 2014 has been a year of economic anxiety and political fragility. A consumption tax that threatens to derail Abenomics, Japan's fading policy designed to reinvigorate that economy, protests in Hong Kong, massive street demonstrations in Pakistan, a military coup in Thailand, a ferry disaster in Korea that triggered national mourning and curtailed advertising spend there dramatically. But the biggest source of uncertainty has been the Chinese economy. The new leadership team of President Xi Jinping is attempting to rebalance the economy from one driven by exports and capital investment to growth more reliant on services and consumer spending. This transition has been, at best, clunky. Economic observers are divided on whether long-term structural changes are in the works or whether China is trapped in a middle-income trap. But there is one thing that has incontestably improved: confidence in President Xi. It's difficult to overstate the positive impression he has made on the Chinese people. He is practically revered, but not blindly. His crackdown on corruption is seen as an artful balance of political savvy and reform. His recent agreements with the United States on environmental and high-tech trade issues reveal a crafty leader of a nation that is both competitor and collaborator. In short, the Chinese people think Xi Jinping is smart and switched on. This is a huge step forward. Despite the technocratic skill of Beijing mandarins, the Chinese economy is fueled by intangibles. In any country, but most of all China, anxiety is unproductive. Although the jury is still out on the Chinese government's incremental reform agenda, the people support their leader and regard him as a force of stability. As 2015 dawns, this is perhaps the best economic news of all.
Welcome back to the show. Today we're bringing you our 2015 forecast. So we'll touch on digital in a minute, but first, Doug, you mentioned inflation being a concern. When you look at the CCTV rates at the auction, do you see a lot of concern in that sense, in terms of costs going up significantly?
Well, what we're seeing is quite a trend towards the very popular PSTV shows, the higher rating ones, the Babatunars and things like that. So there is a natural trend for clients to move money to PSTV and then to be in the best shows. So those better shows are commanding pretty high levels of inflation.
And then at the same time, those blockbusters are few and far between.
Correct.
So those rates might go up, but that's really taking resources from the other shows.
Yeah, well, and also the local TV, particularly in the lower tiers, are really struggling to get some revenue. So our clients are hoping that the inflation on the PSTV will be offset by deflation in local television. However, that remains to be seen because a lot of the local advertisers are still very active and very strong and buy TV in a different way than we do and are still investing a lot of money. So it'll take a little time to settle down, but certainly I think the CCTV auction, which wasn't to the extent of previous years, was a little surprising in terms of the overall inflation, which we measured around about 1.5%.
Now, Adil, when people talk about spending in digital obviously climbing year over year, one of the trends that we're seeing recently, at least in the West, is the purchases of MCNs and content creation becoming a real driving force on the digital front. And here in China, online television, online video has really taken off in the past couple of years as well. So can you talk a little bit more specifically about digital spending?
Right. We forecast about a 30% increase in the spends for next year as well. I think that trend is going to continue. Obviously, there is a bit of caution with regards to the new government regulations in terms of what content is allowed, especially foreign content, which is the primary driver of online video. However, we still believe that trend towards investing in online video, given some of the online inflation or TV inflation and the barriers on television, are definitely much more than online TV. So we still think that trend of higher investment or shift of investment towards online video, especially towards published content, is going to continue. Obviously, the rate is going to come down a little bit. It was touching about 40 to 50% in the last few years, and now it's going to slow down probably to about a tune of 30%.
And do you find that clients are actually embracing these platforms and understanding them, or is there still a rush of money first and understanding second?
No, I think they understand. I think they got to the point that it's bringing additional reach at some point, better cost, and another point for those who are coming from, media background basis. But the other one, we understand marketing a bit, better. They really understand that this is where they create an engagement and a communication with the consumer, because it's just more than online TV, I think regarding the point of UGC, it could be big in China in one condition, that we are able to do real programmatic. And that's the problem here, because not being able to ad prevent you from being very specific and very targeted and very efficient in terms of programmatic buying in this area. And I think there is a huge opportunity. The more we will have the state regulate, the government regulate the online TV, the more we should be able to go to UGC, where actually you have a bit more freedom. But then you need technology to make sure that what you are doing, it's really appropriate for your clients.
Well, and
the consumer as well.
Right, the demands on the technology and the platforms will actually be much greater.
That's crucial, definitely. And for now, we are not in a mature market in this area. But I do believe that actually next year digital will be a 38%, a bit more. I think online TV will be like 50% increase. So again, there will be a huge opportunity because they are reducing the scope of content that will be allowed to be broadcasted. So that's one issue. And there is an increased demand in terms of advertiser. I think the big trend will be search e-commerce. And that will be a 50% increase. Just look at the result, 11/11 result. It's just crazy. But this is only one platform. You have many platforms that are doing very well. So I really expect a huge increase in terms of investment in this area in particular.
Let's switch gears for just 1 second. I mean, in response to these client demands and their shifts in plans, how do you, as the head of agencies, teach your team, train them to be ahead of this curve? Because they should really be leading the clients in all of these areas that you've just mentioned, but at the same time, in an ever-evolving landscape, where the regulations are changing at a rapid pace, how do you get ahead of that curve and get your team to be leading the clients?
Well, it's basically training. We've gone through extensive digital training for all of our business heads. At the same time, we set up a number of specialist business units across search, social, content, and this year we've really made an effort to be like a no-line agency. So our business directors are clearly responsible for driving digital future of all of our client businesses. So previously they used to ring up the experts in search or social or content and say, help me out here, what do I spend, what do I do? This year we're really focusing on they need to become the central people that the clients deal with, because clients don't want to deal with 10 agencies within one agency. They want to deal with one person that fully understands the mix. So that requires a lot of training and effort on our part, and a fair degree of education of the clients too.
And certainly we've talked a lot on our show about how agencies can continue to survive and thrive in the future, and I think training is going to be one of the key aspects to be able to do that. So when we look at fears that clients have, do any of them come to you and say, you know, we're really worried about this area of our business and we need to be spending more to, you know, fortify ourselves in these areas? Is there a particular area that they're uncertain about or that they're worried about, and they come to you to look for help in those areas?
Yeah, I think more recently there's been a huge focus on bringing in the science behind the ad investment. I think in the past, given the massive growth and huge investments, I think and the growth from the client sales perspective as well, there wasn't so much of a focus on the science and the ROIs, etc. Recently, what we've been seeing, or the clients have been coming to us and sort of questioning the rationale behind each and every single investment that goes in and trying to link it back to the benefit, which is basically sales. There's been a huge focus from client side on that, and that they're a bit sort of nervous about it, but at the same time, they would like to understand it a little bit better and see how we can measure things better. And that's been a bit of a gap in this market with regards to the investment and the measurement of that investment for the returns in terms of sales. So I think that's been a huge focus. I think another focus for most of our clients has been innovation. So given how the media world has converged and how the consumer's consumption has converged across different media, it's how do we plan better and innovate, bring in innovation from a media planning perspective to better connect with the consumers in a more engaged way rather than just a simple exposure, which was traditionally how we plan media.
And so building in these systems of measurement and metrics, on the one hand, is probably scary for agencies too, but also for the clients, I guess. Yeah,
but it's something we need to invest in, and you know, I can see a day pretty quickly where a global client can sit in Paris or New York and look exactly at the return of their investment in China and compared to an investment in Australia or the UK, and move money around depending on what is working. But I agree with the deal. It's accountability, measurement, and then, you know, leveraging the learnings to make more profit, drive more business growth.
Now, each of you have been in China for quite a while. Would you say that looking ahead at 2015, are you more or less bullish on China than you have been in the past?
Well, I think, you know, I arrived in China 3.5 years ago, and it was starting to really slow down. And I think it was the best thing that happened in the market, because you can really, you know, touch down the floor and really feel like, okay, this is not the tree that is hiding the forest behind the scene. So I think it's good. I think the more the market, or the more a market is complicated, the better it's for the agency, because our work is to explain the complexity and make it simple and make it seamless and say, don't worry, we're here, we're going to help you. So I'm really not afraid about all this, you know, big data things that saying it's the end of the agency or whatever. We are very strong to reinvent ourselves. I mean, you can look across these people around the table. We are very kind of flexible. It's true that it requires, as you said, lots of training, and you need to keep, you know, the best of the best within your team up to, you know, understand what's going on. But actually, I think this is what makes our job very interesting on a day-to-day basis. It is not the same every day, and you have to really think through what's coming up and do it the best way and explain that to the client. One of the fear of the clients, to come back to your first question, I think it's also the shift from the traditional mortar business to the digital business. And the rise of e-commerce is not going to go away, and it's going to change dramatically the way they're doing business. And if you remember well, a couple of years ago when Murdoch was saying the digital penny against the real dollars, the analog dollars. This is happening right now to our clients because all the retail goes online. So this raises actually a big question: how they should embrace that, how they should shift, how they should keep the balance. We are at the heart of that because we are the guys who transform ourselves at the first place.
Well, staying on that note, actually, how does that affect the luxury sector? Because obviously they've been hit in the past few years specifically by austerity measures in China, but now also digital, because traditionally luxury houses are very reluctant to move their prime product, their current product, to online sales. We've seen some platforms start to work with brands to move a portion, but you see still a lot of luxury brands perhaps not adapting as quickly. Do you think this is going to change? Is there going to be a real tide shift this year, or do you think that some of them will still hold out?
It's going to take time. They're going to go through this in their way, but you have to know that the number one touch point for a luxury brand still the store, because this is really where you can have the real experience. And I think they have really demonstrate how they can train good people in their store because they have been here for many years. The economic crackdown is touching two areas in particular. One will be alcohol, the second one will be the watches. But the luxury ready to wear woman or anything that touched a woman is actually increasing a lot, because you have more and more powerful women in China that want to reward themselves. So this business is doing quite well, and they know how to reinvent themselves as well. I do think they're going to embrace the e-commerce in their own way. I'm not sure that they should do it now if they're not ready, but this is something that we are preparing with them. And it's always a key question: standalone digital store, or I need to go through a platform? If yes, what platform? I think for a luxury cosmetic brand, it's easier than pure luxury fashion or high-end jewelry. It's a key question.
And Adil, can you talk about one particular sector that you're excited about in the coming year?
I think primarily a sector that's targeting moms and kids. I think that's going to continue to boom. And just coming back to your luxury question as well, because it relates to this sector as well. I think I prefer to use the word premium because there's consumers in China are willing to upgrade, and that still remains very, very high. So depending on which category, which brand you're talking about, I'm still quite bullish about so-called premium brands, because the Chinese consumers, regardless of the economy tapering down, still remain very bullish about upgrading any product or any brand that they're using. With specific mention of the mom and kids categories, or the brands active in that segment, I would say we're quite excited about that, because there's a lot of new entrants in that market, which are relatively premium brands. And I think they would continue to invest and make this category expand, especially on the premium end of it.
And Doug?
Look, I think, like Adil, I think the baby sector is continuing to grow. There's continuing concerns on food safety, so I think quality FMCG brands will do well. Infant nutrition powder particularly. I think luxury to a certain extent will come back. Look, I always think that we're very lucky to be in China. We may talk about some of the challenges that we have, but other markets are talking 2% growth, 3% growth. The digital isn't as happening to the level that we've got. E-commerce is a whole dynamic factor. I've been here 12, 14 years, and I still pinch myself for how lucky I am to be part of this. So it's just a great place to be, and the world is changing so much in what we do. Every day is a new day.
I mean, all we have to remember is that this is the second largest market, and it's still growing at 7.5% or 8%. That's a big number. Yeah. That's a big number.
So if you had to use one word to encompass your clients' feeling about China in the coming year, what would that one word be? Be
brave. I think take some calculated risks. There's a danger for us, like we talk to, well, it is a little bad, let's retreat. I think the winners will be those ones that continue to invest smartly, innovately, and in a way that gets some clear measurement. So I think be brave a little.
I would say be more strategic. That's an opportunity. You're less on the, there is this huge growth, we need to grab, the low-hanging fruit. Yeah, just take it. Well, yeah.
Take a step back.
Take a step back for a while and think about it. And think not just for next quarter or potentially next year, but what's going on, in the coming year, and be more strategic and grounded to the big fruit that you can actually grab in the very near future.
Adil?
I think for client sentiments that I've come across, I would use two words, cautiously optimistic. That's what I would say.
Great. Well, thank you for being on Thoughtful China.
Sure.
Thank you.
Thank you.
That wraps it up for today. Be sure to subscribe to us on Youku, Tudo, and YouTube. You can also follow us on Weibo, WeChat, and Twitter, and join our LinkedIn group. We'll see you again.